as the co-presenter. This is presented by the Realtor Lender Committee with the Cincinnati Board of Realtors. We started doing these webinars in July, I believe, and we probably will continue these throughout 2013. Would welcome any suggestions for topics going forward. So as far as the housekeeping, there's some tools as part of the presentation. You can ask questions during the presentation, and of course at the end we'll be answering questions as well. So feel free to use some of the keys on the screen there to ask some specific questions. This is Condos Financing Part 2. We did one last month, and we thought we'd go a little bit deeper on some of the condo projects and some of the condo issues going on. What I will say, I guess to preface this, is that when it comes to condo financing, there are a lot of differences between lenders. So this presentation is going to be somewhat very high level, and you'll see that there may be some differences you've heard on between lenders. So please understand we're trying to keep this very generic as much as possible. So, and you could see differences between lenders, especially on the conventional financing. So let's go ahead and get started. Anything else you want to say to kick it off?
Good morning, and thank you for attending. And like Steve was saying, we are very excited at the participation you all have shown in the last few presentations we've had, and particularly the questions. And we hope this is another one. And yes, condo financing is an interesting topic. And I guess, Steve, the most important part of it is that for the realtor to recognize that it can be done. That
right.
It's not a dead issue if a homeowners association is not approved for a certain financing. There is a way to get it done, and the process can differ depending on lenders or the type of financing you're looking for.
Absolutely. So one of the most important questions is, is the association approved? And if it's not, how can I get it approved? Well, each financing option presents its own set of challenges because depending on the type of financing, it's going to be typically a different type of approval that you're going to have to obtain or have in place. And, we're going to focus today on getting the condo qualified and some high-level topics, but specifically talking about the conventional, the FHA, VA, and the jumbo. Those are all different types, and each one of those has a different type of approval process you'll need to go through, or approval already on the books. Established projects, and this is where there's two key differences: established, meaning complete, and new, which we'll cover in the next slide.
I think one of the things we might want to say at this point, Steve, is that we are talking mainly about condo associations that do not have an approval.
Correct.
Right. So it is. We're assuming that at this point it has been established that the condo association does not have an approval, and that is why we're at this point. And where do we go from there? Right.
That's correct. It is important to, and we covered this in our last webinar last month, is if you take a new listing or if you have a buyer interested, it's very important to find out early on, before you even write an offer, if the project is approved for what kind of financing. So that research is necessary. We're going to go dive deeper to talk about if it's not approved, how does that happen, and how do you go about the process. Well, the first part is established, meaning that it's complete, 100% typically. There's no additional phasing, meaning there's no provisions in the bylaws to build additional buildings. 90% of the units sold and closed. That number can vary depending on lender. The owners are in control of the HOA. That's an important piece of being an established project. All the amenities are finished, pool, play yards, golf courses, anything that's part of the project should be complete. And this is key with most projects, that no more than 30% of the units, total units in the project, are owned by investors. And no single entity, person, or group owns more than 10% of the units in the project. Okay?
And when we're talking about investors, we are saying rental units, right?
Yeah, non-owner occupied, correct. That are not, the current tenant person in there does not own that unit. They're renting it from someone else.
Another thing at this point we can say, Steve, is that the easy way to get this information is through the condo questionnaire.
Correct.
And if either you can go to
condosearch.com,
or the homeowners association would be able to fill out that questionnaire. So a lot of this information can be had quite easily from those two sources.
Right. either the association will have it, or what's common more and more anymore is that the management company or association defaults to using condosearch.com in this case to get all the information completed. And there's a fee for that. It might be $50, $75 depending on who's doing it.
Normally 75 if it's a condo association. I mean condo search.
What makes it a new project? Well, it could be subject to additional phasing. The association has not been turned over to the it's still in control of the developer. You don't have 90% sold and closed, and the amenities may not be complete. And the reason that would make a difference between the existing and the new is that there's a different set of guidelines for these two different project types, both new and existing. One thing I'll mention, too, as far as the existing project, most lenders on conventional financing have provisions if they're putting quite a bit down, usually that's 30% or more, then they don't have to go through the project approval process or have the actual project approved. Most lenders will accept no approval with 30% or more down. So that is lender specific, but keep that in mind too. That means you don't have to go through and find out if a project is approved. You pretty much go to that lender and they'll be able to finance it without a project approval.
Also, I think, and this is something that I've heard, I haven't been involved in this, but I've been told that in the case of some new projects, if the unit you're trying to get financed is the one that puts them over the 90% to be sold, then it might be possible to finance. There are some lenders who will make that concession.
Correct.
So, that also said that that's another thing to keep in mind. There is a certain amount of variation and flexibility that lenders do offer case by case.
Other types, and let's talk about this, there's other types of projects that sometimes you can't tell by looking at it what you have. One is a townhome, and this gets very confusing. If it looks like a townhome, it still could be classified as a condo. You really can't tell by looking at it. You have to really get the declaration, bylaws, information from the association or condo search. It really comes down to how it was legally described and recorded at the courthouse. But in general, a townhome usually does not need to be approved by a lender because they basically own the building. They own basically the land below the building. That's the most generic way to tell. But a townhome typically, and it's hard to tell by looking at it, but you don't need to get an approval. Again, you won't be able to tell unless you actually get the condo documents. It's hard to tell by looking at it, but those don't have to be approved. High-rise, they have some other special considerations for high-rise, and that's usually more than 4 units. We don't have that many high-rise in Cincinnati. They're more prevalent the East and West Coast and other major metropolitan areas like Chicago, but they have their own set of guidelines in addition to what's required typically. And a lot of those, too, will be in the jumbo category as well. There's a new kind of a condo project name. It's a site condo. FHA just recognized that a couple of years ago. Or detached. I know in Cincinnati there's several developments that have detached condos. You'll see a building that have 4 units, all ranch, 1 story. It doesn't look like a condo, but it technically is a condo, and it's described as a condo in the bylaws. So again, it goes back to you can't tell by looking at it. These are usually developments that cater to the retired individual. But sometimes they're called patio homes as well.
Is that something that is also referred to as a landominium, or is that different?
It could be. Landominium is a term that's used over a broad description of many different types of condo units. It could be considered a townhome. Technically, it's not used to describe a condo directly for classification purposes, but it's kind of a word that's used by many realtors and people in the industry. But good question. But the site condos, detached, it's hard to tell by looking at those. You really have to, again, do the research, find out what you've got there. Some are listed as condos and some may not be. 4 to 10 unit projects, anything with a smaller number of units, less than 10, usually has some additional requirements that you have to adhere to or would be required for that project, whether it be conventional or FHA or VA. And then jumbo loans, anything over a 417, is really lender specific. Some will follow the Fannie Mae, Freddie Mac guidelines, and some will have their own particular guidelines as far as condo projects. So that category is basically up to the lender to describe what they can do as far as condo financing.
And Steve, on the jumbo side, the last few times I've made inquiries with some of the lenders, their starting point is always the condo questionnaire. They say, give us the condo questionnaire, and from there we can tell you what else will be needed to get it done.
Okay. How to get it approved? Well, first of all, there's a list that is generated for VA FHA, so you can tell by a list if it's approved already, but it gets a little bit more confusing and difficult if it's a conventional loan. Technically, there is, used to be actually a generic list for Fannie Mae and Freddie Mac, but they've kind of gotten away from that, and they have done more or less a lender-by-lender approval process where, again, that kind of questionnaire is what you need to find out if it really is approved. You'll find if the project was built by a builder and they went in and got not just the FHA, but they've got the conventional Fannie Mae approval, you may see it on the list because that builder went through that process to do it up front while they're building that condo. Unfortunately, those approvals do expire at some point. They have to be updated. But there are lists out there, but they're more specific to FHA and VA. But how to get it approved? The association needs to help the lender out or the realtor. There's a lot of paperwork that is needed, and paperwork such as bylaws and declarations and bylaws. Need to get insurance certificates to make sure that it's insured properly. There's very specific guidelines on how much insurance they coverage. Is it in a flood zone? Most lenders have a list of what kind of documents you need. It is fairly lengthy, but the association has access to most of those. And anyone living in that project should have already received those condo documents from the association as well, but it's one of those things they don't keep. Sometimes they'll throw it away, and most owners don't seem to be able to find those documents after they've moved in. It can be as simple as filling out a few forms. Sometimes all you need is a form filled out, like Ashok said, the condo questionnaire, and that is enough information, especially on existing projects, to be able to have a lender say, we like the project, it all checks out, we'll go ahead and lend on this project for this particular borrower. It can be that simple.
And the other side of it is that once you have that project approved by that lender, then you can keep on going back to the same lender for that particular type of financing. Okay. So I think once you've done the groundwork on a particular condo project, you really have done the best part of, so basically the hard part is done. So once you have that approved, you know the lender lends on it, that's it. Then you can keep on going back to the same well, I guess, huh, Steve?
Right, pretty much. For the FHA and VA, if it's not already on a list, there's two different types of processes you can go through. It's called an HRAP or a DELRAP, and those differences are either the lender is involved with the approval or you go straight to FHA. The requirements are very similar, whether it's an HRAP or DELRAP. I won't go to them at this point. Not all lenders do the HRAPs, or DELRAPs, I'm sorry, so you have to find a lender that is set up and willing to do that. The risk for the lender is that they approve a project and for FHA and follow those procedures, they're taking some risk that the project meets the guidelines, and most lenders are not willing to do that. So you don't see a lot of DELRAP approvals or lenders doing those, but there are some out there. But what you're finding now is that the FHA loan or project was approved, but it's expired because they added an expiration date a few years ago that it can only be approved for up to 2 years and then must be looked at again. So you're going through a process frequently to reapprove that. And again, you'll have to get some of the same documents you needed up front, depending if it actually expired. It makes a big difference if the condo project is FHA, if it actually expired, or if you're going to extend it before it expires. FHA requires less documents to extend an approval versus if it expires, you're kind of starting over to a large degree with documents. And VA is somewhat similar to FHA. The timing it takes to get a project approved, it can be somewhat lengthy. The biggest time that takes is getting the documents. Once you get the documents, there's a back and forth process where there might be some things missing, the association missing some pages, or they weren't recorded. So a lot of it, the time is taking in the data collection. Once you have everything and you submit to the lender or FHA, depending on where it's going, whether it's in Ohio or Kentucky, because there's two different FHA centers the project goes to, last time I checked, they were taking 3 or 4 weeks, sometimes it's longer, just to get the project reviewed. So on average, to get one approved FHA, I usually tell people it's going to take upwards of 60 days or more, depending how good the documentation is and how quickly we can get it. So if you have someone that just bought, trying to get FHA approval at the same time, it's going to be problematic. It's going to take probably longer than the contract you have written. But it can be done. It's just going to have to probably extend the contract. That last point, working with a lender that is knowledgeable with the process is going to make it easy. That's key. Someone that knows the condo market, has things set up for that is going to be very important if you're going to get a project approved. A good part would be if you get a new listing and you know that it's going to be attracted to a certain type of buyer, maybe FHA, is to try to find someone that might help you and work with you to get that project approved, not just for that one listing, but maybe future listings as well.
I guess at this point, I think we can, go ahead, I'm sorry.
Difficult projects. I thought I'd mention a few things that will be difficult. You may run into roadblocks. One is condo hotels. Condo hotels are called. You don't see them in our area, but if you have someone that has bought a vacation home in Florida, you'll see these. It's basically a condo with hotel-like amenities. It's hard to tell by looking at it, but they usually have a front desk, like a concierge desk, like a hotel would have, but it's really a condo. And those are difficult to finance. You can get them done, but they're very difficult to get financed. And they're called condotels.
Typically, those are more expensive, aren't they?
Yeah, they're
condotels.
They're higher end.
They're more on the luxury side.
And they're usually high rises.
So
on the beach.
Yeah, so I think what happens in those cases is it's, again, very lender specific. But you can find a lender who's looking to do those type of, they're looking for those type of loans, and they have their guidelines as to what they would require as a down payment and things like that, or how much equity they'd want to borrow to carry. So, again, those can be very lucrative, but you have to do the homework on it.
Right, and they usually require more of a down payment than they would typically. Manufactured housing units are difficult to finance. I'm not sure of any projects around here in our market or any around here, but they are difficult. If you have more, I got width there, spelling error, but projects with more than 30% units owned by investors, those can be difficult because those are not acceptable by many of the agencies, FHA, VA, conventional, and so forth. So they can be done, a little more difficult. And if there's a large amount of delinquencies on the HOA dues, that's been more of a recent issue. Those become difficult to finance as well. It depends on if there was foreclosures in there. There's some considerations for that, or if it's just the unit owners as a group are not paying their HOA dues. That can also make it difficult to finance. You won't know that until you actually get the condo questionnaire filled out. That's one of the questions on there. So you'll know that that's going to be an issue. You may have something that looks very good and provable, but that could be the one thing that would make it not approvable. And it's happening, as I said, more and more in recent history with projects. So. Any questions? We can go pretty deep on this topic, and there's a lot more in depth that we can go, but we just wanted to kind of give, as I said, kind of a high level. The key, I think, to getting a project approved is working with a lender and an association that is willing and knowledgeable at getting the project approved, and depending on what kind of financing that the buyer wants will be specific to what documents you might need. And as Ashok said, the condo questionnaire, I think, is first and foremost. That would be the first thing that I would get done on a project if you have a listing or have a buyer that's looking to finance one.
May I make a comment here? You know, Steve, one of the things that we've found in our business is that some of these things that look difficult and people shy away from them because they need more paperwork may actually present a huge opportunity for the realtor, because if you like doing condo financing, or if your buyers like condo financing, you may have to do a little bit extra work up front, but once you've got that project cleared, you could be the sole person selling those condos, and you could become the go-to realtor for that, because the other realtors are not going to know that they can get through the process or that it's been approved, because it would be a specific approval for that lender pretty much for you. So in some ways, you created your own market, and I think that can be the good news.
Very true. Very true. I mean, it could be, it could turn into a farm area if you get a project approved and you can market to other unit owners in that project and help them sell their units. Normally, once you have a project approved, be it FHA or other types of financing, it does open up many more options for selling those and does maintain, thus, I think, some of the values in that project. Because frequently some people feel like they cannot sell because the project doesn't meet the standard qualifications.
Okay, here's the question, and I think this is kind of puts you a little bit on the spot, Steve. And
me on the spot, or you on the spot?
I guess me on the spot. And the question is, do you have an example that you know of where someone got a condo approved, a condo association approved, and what steps did you have to take to get it done where it looked like it normally wouldn't be done?
Let's see, an example of that.
Even if it's hearsay.
Yeah.
Let's say, because we can't talk about who the lenders are.
Right.
I could think of one. I'd heard about this one where it was actually a 4-unit luxury condo, and 3 of them were owned by, were owner occupied, and one person wanted to rent it out. So even if it was the owner, and basically they were able to submit all the information that was needed, and they got approved. And from the outside looking in, it didn't have Fannie Mae approval, it did not have FHA and VA approval, and it would have looked like there was no way of getting it done. But I think within a matter of, I heard that within about 2-3 weeks, that unit was approved and they were able to qualify for financing. Because the only issue there was about the rent issue and things like that, and they were able to overcome it because of some compensating factors.
That's a good example. I do have one that just came to mind. There was an agent called me. They had a transaction in process with a local lender, and the lender told them that they could not get the project approved. They had done their research and got paperwork, and they couldn't get it approved. They felt that the loan officer really wasn't knowledgeable, and they weren't not getting the correct information, so they came to me and asked me a few questions. And I didn't know the project offhand, but I said, we give it a shot. So the lender agreed to let go because they said they couldn't finance it. And we worked with the association, got the documents, and actually got it approved FHA. It took about 90 days, only because the documents the association had were not up to date and a lot of things were missing. One of the things in that project was it was right on the verge of having too many delinquencies for HOA dues, which would have kicked it out. Additionally, and what we did is we had the association write a letter to explain why the percentage was high, and it was high because there was a couple foreclosed properties in that development that were bringing down the ratios. So once they explained that and they discarded those 2 foreclosures, the delinquencies were within the tolerance of FHA. We ultimately did get it approved, and they did close on the project. And I'm not sure if the agent did any other units in there, but it was approved for everyone because it was an FHA financing. So that's one example, I guess, comes to mind.
And what it really boils down to is you being able to, you as the realtor having enough motivation to find someone that will work with you, because you can get definitive answers as to what it would take to get the condo approved. So that would be, Steve, we have another question. And the question is, how are the guidelines different for purchasing a condo out of state?
They're really not any different whether it's out of state, because we're talking about FHA, VA, conventional Fannie Mae, Freddie Mac financing. So the guidelines are the same. I will say that there are some specific additional rules, not just on condos, but on certain areas that have high foreclosure rates. For example, Florida. Florida has its own special set, additional layers of guidelines, not just for condos, but also for single-family homes. But outside of those areas, there's been a lot of delinquencies, a lot of foreclosures, like Florida, for example. It's pretty much similar. Texas has some special rules, not because of delinquencies. They just have a lot of different lending rules. and also Nevada does too, and because of the foreclosures. So outside of those areas I mentioned, the rules are pretty much the same throughout the country.
And actually, you can have some lenders that will specify that they will not do condo financing in certain states. And Florida and Nevada do come to mind for that. I haven't seen Texas on the list, but I have seen Florida and Nevada as being ones that they will not do condo financing in. We have another question here, Steve, and this has to do more with if you are looking to purchase, and you find that the condo association is not cooperating. What are some of the ways of, and this is really a very good question, what are some of the ways of maybe getting the condo association to see that it's to their advantage?
Well, the two things. One is that the owner of the unit, can put some pressure on the association to cooperate with the lender and the realtors and the parties involved, because that's part of what they're supposed to do. As far as the attitude on the financing, getting it approved, say FHA, some associations feel that if they approve it FHA, that the individual buying the project or buying unit, is going to be a different kind of person than they want to bring in there. Now, that's obviously doesn't meet fair housing laws, and they won't tell you that face to face. But I have been told that they don't really want to cooperate directly because they do not want to get a project approved FHA. A lot of the information is incorrect because they have a feeling about FHA that maybe was true a number of years ago as far as the difficulty, but I think everyone would agree that the financing for FHA has been very prevalent in today's market because of the flexibility of the guidelines. So you do run into it sometimes, but it's becoming less and less of an issue.
And I think it may even behoove the buyer of the prospective buyer of the unit to call the homeowners association and say, look, I'm ready to buy. Maybe it might be a leverage type of action. I'm ready to buy, and you guys are not doing your part. Maybe there might be some leverage, and then again, you as a realtor could prevail upon them by saying, again, the homeowners association is missing out on some opportunities.
Is there any additional questions that anyone has? We can hang on for as long as possible. I know this market for condos is somewhat difficult. That's why we had the last 2 months talking about this, because I think it's a good market for condos. You just have to know how to navigate in some of the rules and regulations for them. It's a big part of the market here locally, and we'd like to keep financing.
Okay, here's another interesting question, and I think we've been talking about this a little bit, Steve, and it has to do with, bottom line, does it make sense for a realtor to go through the hassles of trying to get a condo association approved when it's not on one of the Fannie Mae, Freddie, FHA on the various lists? Would it make sense for a realtor to really take time off some other stuff that they're doing to get a condo association approved?
Individual answer, but the way I would see it, I guess it depends on the client. If they really need the help, you want to help this client out that might be in some needs. I'm assuming it's a listing, number one. But number two, is it, it could be a future source of business. If you approve it and get a approved FHA or VA, that's open to everyone. That opens up basically a market for that particular project for you that you personally could say, we've got it approved. I was personally involved. I'd like to help you sell some more of these units, and knock on some doors and send some flyers out. So I think it's not just helping out your customer at hand that might really need some help, but it's also could be some future business for you. That's why I would look at it.
I think, and Stephen, another perspective on it could be that, it's not the low-hanging fruit.
Right.
There's some work involved, and because of that, you may actually be able to put yourself in a position where you are the person that is referred by the condo association, once you've got it approved, by the condo association as the realtor to go to for getting it done. Mm-hmm. And that could actually give you an edge in getting some extra business. So, yeah, I think it makes a lot of sense to investigate it further and find a lender that will help you go through the process.
Yeah, if you're busy now, you have a lot of business, and you don't think you'll have the time, that's a whole different set of circumstances. But if you have the time and willing to put forth a little bit of extra effort, it could be some extra future business for someone, in that particular project.
Yeah. So you would think that it's definitely worth the effort.
I think so, especially if they have time. If they're busy enough, they might, they may not be able to fit everything in. Obviously, once you get it approved, then you've got it approved for, in the case of FHA, 2 years, and you've got a future stream of business potentially as well. You don't have to keep doing it. Any other additional questions? We had some really good questions so far. It's, of course, an interesting topic. The last 2 months had a lot of good questions last month as well. A lot of misinformation, too, about condos. Some builders have pulled back on building condos. These are developers that historically that's part of their business model. And some have put it on hold to see if the economy turns around. Some have not, but there's still people building condos in today's market. Do you have another question? I can't see that. Okay.
What's a good source for more info on this subject?
Let's see. Well, you can get information at FHA and VA's website on condo financing. They will give you all the information as far as what's needed for approval of the project. As far as Fannie Mae and Freddie Mac, they also have their information on their websites as well, as far as what will take to get projects approved. So those 4 lending websites would be a good source for you, because they each have a little bit different guidelines for you.
But if you want to take the path of least resistance, a good lender. And more often, more than that, a lender and a loan officer that's committed to working with you and help you develop your business. I think that's the critical part here.
Yeah. Understand, too, from a lender's perspective, if you're trying to develop business, that's what this really is. If it's, besides just maybe helping out one client to get them financing, is if you're looking for some additional ways to expand your business, there's a lot of upfront work, and both for the realtor and the lender. So I think there needs to be an understanding that hopefully by doing this upfront work, there could be some future income as far as loans for everyone, and sales for the realtor too, by putting the work in. Because you're putting some work in up front, hoping to have some more sales in that project and some more revenue. So it's definitely some upfront work on both parts. All right, I don't see any more questions. We went a little over 30 minutes. Great questions. Look for an announcement from the CABR as far as the topics for the next webinar. We'll have it in January. Usually it's about the second week of the month, and in that we'll get that out to all the members. But we appreciate the people that had signed up today, and also the questions, some very, very good questions. So thanks, everyone.